it's really very tricky to actually pre-identify what's going to be the black swan, but we know there are plenty of swans out there flying around. It's a very dicey situation, I would say, out there right now, because that kind of contagion affects all markets, mostly in the negative, and it affects the overall economy.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for December 1st through December 8th, 2025, while supplies last. First this week, 2025 1-ounce silver Canadian maples are just $4.50 over spot. 1 10th-ounce gold Canadian maples are only $60 over melt per coin. Next, 100-ounce Silver Asahi Bars are just $3.45 over spot per ounce. Finally, 1-ounce platinum maples are only $195 over spot per ounce. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is Dr. Mark Thornton from the Mises Institute. Dr. Thornton, thank you so much for joining us today.
No, it's my pleasure to be here.
Well, it's great to have you today. I did want to discuss what is happening in the markets, in the stock market, the precious metal markets. It seems like everything is going higher at the same time, especially metals and especially silver that we've talked about before. But first and foremost, if we could get maybe a broad overview of where the economy stands right now. I know you did a video recently about a possible contagion in the markets when we're looking at the Japanese bond market, or really any other bad situation with respect to different financial institutions. Everything's so interconnected nowadays that things could get out of control. So can you expand on this?
Yeah, well, I think a lot of people, even in the mainstream media, are worried about contagion for some reason. Now, of course, they all deny that there's any contagion out there, that it doesn't really exist, and that it doesn't affect this market. But just the fact that they're all talking about it, I think, is something that should have us all worried. Quite naturally, they're not going to admit to contagion or any particular source of contagion. And indeed, spotting black swans in the economy that could fly into the situation and upset the apple cart and really send all markets into chaos is incredibly difficult to do. But what we do know from Austrian theory, the Austrian theory of the business cycle, is that when you have an activist Fed with a Keynesian philosophy and an interventionist socialist mindset, that their activities really create the conditions, create the leverage in assets, create the uncertainty in markets that are the prime condition for contagion in the economy, and contagion particularly in asset markets, and even more so in asset markets where there's not a lot of publicly disclosed information. And so that's typically where problems will start. For example, during the housing bubble, the problem started in the securities, the collateralized debt obligations and the mortgage-backed securities, which a lot of people didn't understand. So the stage has been set by the Federal Reserve. And there are a number of places that might be black swans. And really, it's not the black swan is really just the first thing that emerges and starts the contagion process. So it's really very tricky to actually pre-identify what's going to be the black swan, but we know there are plenty of swans out there flying around. And I've just been adding to the number of potential black swans that can kick off this contagion and upset this leveraged apple cart of a financial sector in our economy. And certainly the Japanese bond market is a big concern, and the unwinding of the yen carry trade, the commercial real estate market, which has been covered up really by the Biden administration and to a certain extent the Trump administration trying to force the bankers and the borrowers to roll over existing commercial mortgages out of line with tradition. And then, of course, there's private equity and hedge funds where a bunch of companies have either been entered into the marketplace or taken out of the stock market and put into this private equity where no one can see what's going on, where the reporting standards are not as clear and complete as they are for publicly listed corporations. And, you just talk to people in that industry, the people who are selling these products, which are highly leveraged. That's part of the whole process of taking these companies and adding a lot of leverage and maybe expanding their investments and turning them loose and having to pay back, a much greater loan burden or bond burden. So they're kind of like the junk bonds from previous decades ago. And so we've got a lot of situations out there in the economy. And I think, I think the reason we're all attuned to this is because the Mag 7 and the stock market itself is no longer shooting up into the sky like a rocket, but rather the technical analysts tell us that it's at the stock market, the S&P 500, the NASDAQ, and the Mag 7 are all right now kind of in a holding pattern. And so, it's a very dicey situation, I would say, out there right now. It's something of major concern to stock market investors, although, frankly, I don't think, I think they've been lulled into being apathetic about the situation because we've had a 16-year bull market in stocks right now. And so they just see, they check their 401ks and everything's going up. And so they really have tuned out to their due diligence when, their portfolios, of course, are always at risk. But I think there is a big reason for concern because that kind of contagion affects all markets, mostly in the negative, and it affects the overall economy.
Certainly. And one of the, pushbacks some people give with respect to the stock market potentially looking toppy at the moment is it seems like a lot of people are recognizing this and that typically during a topping phase or a blow off top, you see everyone jumping in, and you don't see everyone calling for a top and stuff like that. Everyone is very, very bullish. What do you make of it seems like even on the mainstream, unless maybe you see things differently, that it seems like there is a bit of caution out there at the moment, which might not signal a crash ahead.
Well, I think there's concern, and I think people are alert to, the possibility of a crash and the possibility of contagion. But we've had this 16-year bull market, and we've seen a tremendous leveraging within the Mag 7 just within the last couple of months. And if you look at the overall, statistics regarding, cash balances in accounts and margin accounts, there's been no pullback. There's been no defensive stances taken as far as the overall market is concerned in aggregate. Now, I think there's some indirect evidence that the bigger players and the institutions have pulled back somewhat. The people who sold a lot of this stuff in private equity, for example, they're not as much directly holding the bag there. But overall, the margin debt is very high. The cash balances are very low. There's people investing in triple leveraged ETFs. As a matter of fact, I think it was the Securities and Exchange Commission came out and said, well, we've overdone this leveraged ETF business. I think there was a bunch of 5 times leverage funds that wanted to enter the marketplace, and the SEC put a moratorium or something on that. So I think we're alert to the fact of this possibility because of this this self-financing within the Mag 7 for these data centers and chips and so forth, where they're lending people the money to buy their product, which is also another sign that the market is sort of topping out, where the seller has to give the money to the buyer and lend the money to the buyer in order to sell their product. So that's something that happened during the tech bubble. And so there are these reminiscent signs from previous painful bubbles that have emerged, and people have noticed them. But as far as I can tell, they haven't reacted in terms of taking a more defensive stance. And I think if everybody did take a more defensive stance, that the markets would start to go down. So, Mises said that, if you actually could predict the future with certainty, then everybody would react to it and it would come true much earlier than your prediction would have stated. So we don't know the future. I can't say for certain there's going to be, a bear market or a stock market crash or a crisis in the economy with certainty, and nobody could do that. So, I think a lot of the smaller players are just letting their chips stay on the table and playing the game, continuing to play the game. The money that's fueling Wall Street right now is a lot of retirement money. It comes in every month. Existing accounts of retirees, some of that money is getting rolled over into ETFs and mutual funds and other investments. And so, we haven't seen any big moves on the part of the investors. Particularly, I'm mostly concerned with the small investor, the type of people that I live and work with and, are in my hometown, and they're not the big players. And, I don't see any awareness on their part of the enhanced risk that currently probably exists.
One sign that we have been seeing over the last couple of years is the run-up in metals prices, which, especially for gold, typically is a sign that people are concerned about the state of the economy or concerned about inflation. What is your take on, just in the last couple weeks, really, since Thanksgiving weekend, we saw that huge rise in silver going to about $59, now pulling back today as we record this on Thursday, December 4th. But your take on that huge surge in silver that we've seen, and really silver outperforming gold in the last couple weeks?
Yes, well, that's something we've been looking at all year, but higher metal prices for gold and silver, those markets absorb all of the uncertainty and potentially bad things and actual bad things that exist in the economy, whether that's uncertainty or government or war or, downturns in markets. Those precious metal markets are like the canary in the coal mine. They're like a giant shock absorber for those who invest in it as a matter of diversification. And the fact that we've seen this huge run-up, there are certainly some fundamental factors going on there, but basically it's a reaction to the threat of future inflation in the economy and the large amounts of uncertainty and the increased international tensions. Now, we talked about this quite a while ago as silver was headed to, it hadn't quite gotten to $50 the first time. And I said, the market is going to be experiencing growing pains when we get to this new level, because it's a psychological level, and it's going to bring in, and it was bringing in already, new institutional money, new investors' money, speculators, day traders, all of that. And so the silver marketplace has become a bigger phenomenon, and it's making a lot more news stories now. There's backwardation in the market. We had the problem at the COMEX. We've had the problem at the LBMA. We've had, these wholesalers having to fly silver all over the planet to try to equilibrate their own holdings and their own positions. And so I'm afraid we're in for a much more of a wild ride in precious metals, because it's no longer central bank stackers of gold and small independent silver stackers of silver, but we've got these bigger players in the marketplace. Their attention has been drawn to silver, and now we have countries, Saudi Arabia and other places accumulating silver or thinking about accumulating silver. And so I think these dollar plus swings in the price of silver are going to become the norm rather than the exception. It used to be a big day up or down in the silver market if it changed 30 cents. And now we think of that as no change, that nothing has changed in the market. So there's a lot more volatility, and we're all going to have to get used to that. We're all going to have to, us stackers are going to have to get used to the fact that silver is no longer 20 or 30 something dollars an ounce. But it doesn't really change the fundamental thesis of stackers and the strategy of stackers. But psychologically, it is a barrier to all of a sudden have to be paying $60 or $70 for something that you used to pay $25 or $30 for. But yes, the market is very volatile, and the wholesale level in this of the silver market, where miners are disposing of their production, bankers are financing, bringing that production to market and selling it to the fabricators and the mints and so forth. That market was very small. It still is small, but it's getting bigger. And it was very tightly held. And, as a lot of people know, the inventories in silver were very, very small. They're very, very small right now. And so there's going to have to be a lot of adaptation. I think the market is going to go through some really significant structural changes. I think the Chinese and the Asians are going to play a much bigger role as we go forward into the future. And, into a future where we get less backwardation of the price and more inventories in the marketplace and more stability in the price. And so that's something that, that's something we're just going to have to live through until we get to the other side on this.
It seems like certainly more dynamics in the markets, different considerations retailers and wholesalers are having to make at this time, as it seems like really a big driver of the price is institutional buying and people looking for the COMEX bars, right? The shortages in London and all of that. Really, it's a new game now. It seems like where there's a demand now for pure silver in the COMEX bar form. I guess your take on that. Do you see that continuing where we're going to continue to see shortages in some places on the physical markets?
Yes, I think we're definitely, the inventories at the wholesale level are very low, and there's a lot of concern from the players in those markets about that. So shortages and disruptions that it is causing on the supply chain to the wholesalers and to the coin dealers, the physical coin dealers and the online coin dealers. I mean, I don't know how that market works. Thank God it does. But it's making it much more difficult on all those players. And for stackers, I think it's a pretty straightforward. Now, this is something that at least I think is straightforward with respect to all of that, is that, there's seems to be an insatiable desire to bring silver from the local and retail levels and bring it back up into the wholesale levels and put it into these gigantic wholesale bars of silver for the wholesale market. But then also the refiners aren't accepting, sterling silver and junk silver 90%, and all that stuff because it takes too long, it's too complicated, and their businesses are runneth over with the amount of money, the amount of silver money that is being dragged into the refiners in order to provide for the wholesalers. But the fact that they're not accepting constitutional junk silver and Jefferson war nickels and T services and, sterling silver and that sort of stuff means that while premiums have been pretty volatile and high for a lot of items, the premiums for the constitutional junk silver, war nickels, and that kind of stuff have been really, really low. So, the stacker has to be opportunistic. And I think right now, to me personally, that is the adaptation that makes the most sense, is to look for that kind of opportunity where the refiners aren't accepting it. So a lot of people are selling their little holdings of silver into the system to take advantage of $57 silver. But the refiners don't want anything other than the $9.99 silver. So you're getting a break on the premium with respect to these other versions, which I've always been partial to anyways.
It is kind of an interesting environment because you have what some people would say the best form of silver, especially if we got into a situation where we had to use it as currency, right? You have small denomination silver, constitutional dimes, quarters, half dollars that are 90% silver. They're recognizable, but they're the cheapest thing out there right now, which is kind of crazy.
Yeah, no, I love, as a longtime coin collector, I love it, except for the fact that I can barely carry my bank safety deposit box anymore. Yeah, it is. It's wonder. I mean, it's part of American history. You can get the old gold coins as well for very low premiums. So you're buying into American history, and you're buying into this the stacker movement, and you're kind of doing it in a small way, in an ideological way, saying, I not only think silver and gold are safe for me and my family, but I'm pointing the finger back in history when the United States was an honest country that had a sound monetary system and became the world's number one economic superpower, bar none. It became the destination place for immigrants from every nation who wanted to be free, who wanted to get out from dictatorships and economic stagnation and poverty. They came to the United States, and, a lot of modern Americans, of course, don't realize that one of the keys to American success is not the geographic place. It's not the color of our flag. It's not the nature of the soil. It was the fact that the United States had a sound monetary system and had a free market economy, and we stayed out of entangling alliances and world wars for the most part. And you can date all of that stuff with the gold coins and the silver dollars, and you get to World War I, and we got dragged into that morass, and we also ended up with a central bank, and we ended up with a gold exchange standard system rather than a true gold standard system. So it's of historical merit that people go back and collect those gold coins and those silver dollars as a matter of personal protection, like a fire extinguisher, but also symbolically as to what really made America great.
Certainly. And if our viewers are interested in learning more, I know you produce a Minor Issues podcast with Mises Institute, and also you have a new book out. It is Hayek for the 21st Century. Can you tell us a bit about this?
Yeah, we have a giveaway. We believe that you can't just be in favor of free markets, that you have to know why free markets work. You have to know why government doesn't work. I mean, it's great that people know that government doesn't work, but if you're challenged, if you have to teach the next generation, if you have to debate the issue in public, you have to know the why. And that's what the Institute does. We teach students why free markets and how free markets work, why sound money is better, and why government stinks. And so we're giving away this collection of articles by F.A. Hayek, who was one of Mises's great students and a Nobel Prize winner in economics for extending Mises's work. I'll be happy to send you the link to get a free copy or copies of this book. Hayek not only won the Nobel Prize, but he came back on the scene in the 1970s to fight inflation. He was still doing theoretical work, but he came back. He was in the United States. He went to the UK. He was the ideological scientific backbone for Ronald Reagan and Margaret Thatcher. And of course, the United States recovered in the 1980s, and the United Kingdom certainly recovered with Thatcherism, which neither one of them were perfect, and we didn't get back to the gold standard, but just those reforms that Hayek helped promote did a whole lot of good, and that's where we're at right now. We'd love to have people pick up copies of this book and spread the good news around.
Our viewers can look in the description of this video for the free copy of that book. So thank you so much, Dr. Thornton, for your time today. You have a good rest of the day, and Merry Christmas if we don't talk to you until then.
I enjoyed it thoroughly, and Merry Christmas to you and your family.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for December 1st through December 8th, 2025, while supplies last. First this week, 2025 1-ounce silver Canadian maples are just $4.50 over spot. 1 10th-ounce gold Canadian maples are only $60 over melt per coin. Next, 100-ounce Silver Asahi Bars are just $3.45 over spot per ounce. Finally, 1-ounce platinum maples are only $195 over spot per ounce. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.